Welcome to Target Market Insights, the multifamily and marketing podcast. Each week, John Kasman interviews multifamily and marketing experts to teach you how to find the best places to invest, attract investors, and grow your portfolio. You are listening to Target Market Insights with your host, John Kasman.
Welcome to Target Market Insights, the multifamily and marketing show. I'm your man, John Kasman, and I want to thank you for joining us for another great episode. Now, if you're enjoying this show, do me one quick favor and leave us that 5-star rating and review. And if you haven't already, make sure you click the subscribe button so you don't miss an episode. Now, today we're going to be talking to Spencer Hilligoss. Spencer Hilligoss is a passive real estate investor, co-sponsor, and former technology leader. His company, Madison Investing, has co-sponsored deals totaling more than 5,000 units for more than $600 million. Now, he invests in syndications as an LP and actively leads Madison Investing alongside his co-founder and wife, Jennifer, on investment opportunities. Let's welcome to the show, Spencer Hilligoss.
John, thank you so much for having me on. You know, being a fan of your show already, it was a very easy thing to come over and say, hey, John, I'd love to talk to you, man, and share some learning with folks. So it's an honor to be here.
Spencer, it's great to talk to you and appreciate the kind words on the show. I gave a little bit of a background for you on your bio. Why don't you take a minute and give us a little bit more context of your background and how you got into real estate?
Yeah, I'm happy to. So I'm based out here in the Bay Area, California, so Silicon Valley. That has been really my work and my passion for the past 13 years has been the local business, and that's tech companies. I mean, it's software companies. You know, I found my way into those 5 software companies pretty naturally, just because I wanted to go do something different than my dad. I did grow up in a real estate household. I mean, I was actually exposed to real estate earlier than a lot of people tend to realize, and I've been told by other folks in the real estate business and mentors, John, I should just tell people outright, because I used to kind of hide from this, that I grew up in that real estate household, got exposure to real estate at the age of 6. I later got terrified by it. You know, my dad was making me work open houses, and I ended up running away from that, going straight into technology. And so 13 years later, I found myself carving out a career in leadership and operations teams and sales teams. And now, you know, for the most recent chapter of my life, I just about 5 months ago, almost 6 months ago now, as time flies, I quit my technology leadership career. And it happened to be right before the COVID-19 pandemic circled the globe, of course, wasn't quite planning on that. But and now I'm a full-time real estate investor. And it started out passive, and now we are both active and passive. And I'm leading this amazing chapter of life, whatever you want to call it, being a very present father and husband to the best way I can be. And real estate has enabled that. So I'm deeply grateful for that. And I'm also just hopeful to share the learnings that we've gotten along the way so that other people can achieve these same types of outcomes for whatever they want to achieve, whether they want to buy a jet. You know, that's not really my goal. I just want to be a great dad and husband, but excited to share the learnings.
Spencer, that's awesome, man. It's great to hear. And just to recap a little bit of that, you're in the Bay Area, you know, real estate was in your blood, even though you didn't really want to do it right away. You kind of went into the technology space. You did that for 5 different companies. And just 5 months ago, you left corporate America and became a full-time real estate investor. Let's start talking about some of those passive investments, you know, becoming an LP investor. As you had your technology job, your technology career taking off, when did you decide to begin to invest in real estate? And what was it that made you do that first deal?
Yeah, man, that's the $1 million question, right? So I had already been go back to maybe 2015. I had already been with 4 other companies, and, you know, started kind of big company in my first job out of college. It was working for a company called Intuit, which a lot of people know in the country, TurboTax, QuickBooks, and all the rest. And then I progressively went to smaller and smaller companies until, flash forward to 2016, a mentor of mine in the corporate world, who I looked up to immensely, he nudged me to go into a real estate tech company, like a hybrid company called Lending Home. And at the time, I mean, I didn't know really anything about real estate investing. I had that exposure to the brokerage side of the world on residential, but I did not know about how much money was being made, how much wealth was being grown on this real estate investing side. So Lending Home, you know, it required a lot of me, frankly. I had to go in and become a loan originator licensed because I had to lead a team of people that were experienced loan originators, and they didn't take kindly to an outsider coming in. So I had to earn their respect. And they're a flip shop. They were doing 150 transactions a month when I got there. And by the time I left, they were doing 600 transactions per month. So I got that exposure seeing how much that these investors on these deals were making deal to deal. And I was like, wait a sec, how come I'm not seeing any of that? I see my occasionally really nice W-2 paychecks from being in a leadership track. I did not see the types of numbers that are so tax advantaged and everything else that you get when you're in real estate. And so I wanted to go and get some of that. I didn't want to be a flipper though. I can barely swing a hammer. I mean, I thank God every day for YouTube, John, because like I can't fix stuff around our house without YouTube. So I don't want to be a flipper. So I did want to go and just figure out a strategy that made sense for us. I like predictability. I knew that from forecasting and doing operations in my leadership career. So I looked for rentals, and Jennifer and I drove around in the Bay Area for an entire summer with an infant son. And this is around 2016. And we bought a duplex, and it was a little north of our house. And I really didn't get this notion of cash flow yet. So we ended up overpaying like crazy. It was such a newbie move. It was $430,000 for a duplex in the Bay Area. There's a loan on it. So we ended up getting $250 a month in cash flow, right? And so before you understand goal setting around cash flow, you hear those numbers and you're like, man, you could have done better than that, right? It's appreciating, which is awesome. But since then, we've learned a lot. We went out and bought turnkeys in the Midwest, and then we finally found our way to becoming LPs and eventually becoming co-GPs and LPs in syndications.
So let's talk about that more, right? So you do that duplex deal. You guys are obviously, it's your duplex, so I'm assuming you self-managed that property, and then you kind of transitioned into more turnkey deals in the Midwest. One of the things when I launched this show initially, part of it was really about understanding how to evaluate different markets, right? So understanding how to go out there, look in different markets, investing afar. When you bought that duplex, which was, again, you were driving around in the city, in the Bay Area, you could find it, you could touch it, you had a sense of those neighborhoods. I'm sure from a location standpoint, you had a pretty good feel of where you were buying. How did you transition that knowledge buying turnkeys and also taking that knowledge and moving on to investing in larger syndication deals?
Yeah, that was an interesting one. So I had a really unique advantage on this step in the journey, John. So if you think about it, when you go and you join a company, so I was at this company called Lending Home, right? And I had to learn and then build training infrastructure for people on how to do the underwriting on things like flips and how we would even lend, like the credit box inside of the bank, just to use the bank terminology. How do you go and speak the language, use the numbers, and then translate that into a really great decision around, do you lend on this transaction? So I got the benefit of that. And I'm so deeply grateful that I found that, because I really stumbled into it. I didn't have some master plan to go work for a lender to learn how to underwrite residential deals until I got there. And then I was like, wait, this is a gift. The challenge of going through this tough experience, learning this stuff, it's a gift. So I was obsessed, as many of us are when they first get into this real estate stuff. I think I read 24 books when I was working on nights and weekends while working a demanding full-time job. I listened to 400 or more podcasts. I signed up for a coaching program. And so the coaching program I first signed up for was a commercial underwriting focused coaching program. And so I got all the terminology that I used from that residential experience in Lending Home, jumped over, started just grinding on learning the commercial side of underwriting. So that analysis foundation was super, super helpful. But I had the advantage of seeing deals, right? I had the advantage of seeing some deals on the residential side, but you got to get your hands dirty. You got to get into it. So I put myself through the ringer on that, built a really strong foundation educationally, which I think is the best possible way for people to start. I think if you're going to be passive, you don't necessarily need to go quite as crazy as I did. But I got obsessed with it. And so I eventually wanted to get active, I guess, out of all that learning. And I realized I could add value back to other people as well.
So the first turnkey deal, after doing all that analysis, really getting a sense of markets, were there key I mean, so let me back up. Um, when I was in the marketing field, one of the things that we realized with our data and our clients' data was that there was almost information overload. I mean, there were so many data points, so many inputs that we could pull and look at sentiment and all these different things. And it was really difficult to figure out which points actually drove the business, which levers do we actually need to focus on. And I think that's one of the things people have a hard time with when it comes to selecting markets. So as you had all that information, which levers did you identify as the important ones? Or was it strictly just about the deal and the returns? Or did you pay a lot of attention to the market specifically to say, hey, similar cash flow, similar markets, but this market is better than that one because of X?
My perspective on this, I don't know if it's contrarian necessarily. I don't hear it that often, which is why I'll bring it up and maybe it'll be perceived as contrarian, which is the biggest learning I took away from being inside of 5 high growth companies, building all these big teams, hiring hundreds of people, John, is that you can build the perfect plan, but it really comes down to the operator. And I'm not even talking real estate. I'm just talking in the corporate context of building heavy operational groups and organizations and companies. And so getting into real estate, even by the time that I got to that early stage for us, it was pretty early in our investing career, back to your question about turnkeys. I saw these vendors that were out there claiming, as they're trying to market their own businesses, they say, buy from us, buy with us, use our property management, go acquire in this market, go buy in Detroit, go buy in Kansas City, go buy in these different places. And if you come in with that ethos and understanding and learning that I got from the corporate world, that the best plan on paper really doesn't mean that much if the operator isn't the right person to be driving that plan. That's how I looked at it for turnkey. And I went and just networked to the point where I ran into a person who was, representing this turnkey vendor, which I'll speak very positively of. We don't buy turnkeys anymore, but I had a net positive experience with them. And I wanted to know who are they as people? Have they done this before? And that guided more than the where initially. I very tightly subscribe to the same belief that I imagine you do, John, and so many others out there that we hear about. I didn't come up with this clearly, but the 3-pillar framework for analyzing something, operator, market, deal, or you can call it team, market, deal. Those 3 pillars, the relative weights. Sometimes I hear people go through how much time they spend on deal analysis versus the person analysis, and it scares the bejesus out of me because they don't spend that much time on the who. And the who, in my opinion, is the biggest deal and it needs the most weight. And that's where I focused for that operator. Because what I was able to do is I was able to back channel I was able to back channel reference this one turnkey vendor and find out, that person that worked with them, they had a great experience. That person over there, they actually transacted something totally unrelated with that other leader in this turnkey vendor. That's what drove my first decision. And then once they picked their markets and they had 3 they listed for me, I was like, okay, well, these markets all meet my criteria so far. So we started looking at things that, that are fundamental for market analysis, like jobs, job growth, population, migrations, all those wonderful data points that we can look at. But it started with the who, man.
That was good. That's great intel right there, right? Figure out the who, figure out the operator, the sponsor, who's the lead. And part of the reason is, if you start with that person, they're going to be able to navigate the market, right? If you get someone who's smart and savvy, that trickles down into their market selection, their market knowledge, the way they overcome any challenges and obstacles in the market. It's not to say you stop looking once you find someone who you think is adequate and successful, that you just do whatever they throw in front of you. But the most important piece is that person, from a market standpoint. This is something we've seen a lot as well, is that there are markets that are phenomenal markets. Doesn't mean you're going to get a great deal in that market.
That's right.
Even if you get a great deal in the market, doesn't mean it's going to be executed, flawlessly. There are a lot of different components that you have to keep in mind. So finding that individual certainly is a strong component of doing a good deal. So in this case, sounds like you found an operator that you liked, that you felt comfortable with, kind of looked at the markets they were in, found a deal, moved forward. Let's kind of fast forward and start talking about some of the syndication deals. A lot of people listening right now are either, passive investors or active investors and trying to build their multifamily portfolio on either side of that coin. What was it like doing your first passive deal, and why did you decide to get into multifamily as opposed to continue to invest in some of these turnkey properties?
I think that there was a moment on the turnkey front that really stuck with me. And it was when we got our first vacancy, and it was because of an eviction. And, the occupancy narrative that I think really just hit home for me as a guy who likes predictability. I couldn't write a forecast for how much cash flow and how much income we could bank on, John, once I saw one of our 5 turnkey properties go from 100% occupied to 0 overnight, and I was like, wait a sec, like if this is how this is going to go, I'm not seeing the predictability that I like and I expect from my corporate career, right? So that was like the spark that lit the fuse for me to go deeper down the rabbit hole on the commercial side and look up market, because the bigger is better kind of theme around multifamily, and knowing that if I have 400 units in a big apartment building and one of those tenants leaves, I still have 399 other people happily living there paying the rent. And so it's got that predictability, it's got that stability. So I found that super, super appealing. I also found it, I'll say this in the most respectful way I possibly can for my residential brethren. I can absolutely still claim to have worked amongst them. So, and grew up in a residential household, but I will say that like there's a certain sophistication and polish professionally and in the analysis and presentation of the deals that you get with commercial. And I really found that appealing. Like I like being able to sit down and have like a common language with a person who has gone through some kind of journey with, analytical rigor. They understand how to put together a clean set of communicable points and all that stuff. So it doesn't matter to everybody, it matters to me. And it helps us get great business done and invest in those right deals. So I looked at that stuff, and I just looked at the history. I looked at the history of multifamily performance, how they did in the Great Recession in 2008 and 9. Right now, we're learning real time how multifamily performs, through a very different type of downturn in the market cycle. And so far, I would say that everyone's pretty pleasantly surprised with how collections are going on rents, despite the doom and gloom forecast. So all of that stuff said, that was an easy decision for us to go look into multifamily. I could probably keep rattling on the stuff that you already know, really, really well, John, around why multifamily was a good fit for us. We do also now look, we have worked on and continue to invest in self-storage and mobile home parks as well. But I would say the turnkey stuff, and kind of looking at how we decided to switch and who we picked to invest with on that first one, it was based so heavily on values, as corny as that might sound. We invested with someone we knew personally. It actually wasn't necessarily like the most experienced operator. It came down to someone that I know would work tooth and nail to make sure that the deal was going to achieve success. And it was in a market we liked. In that particular deal, it was in Alabama. So we loved the market they were in. And we just knew we were kind of making a statement on that first one. We were like, we want to invest our capital not only in a great market, not only on a good deal that pencils out, has a great return. We wanted to put our money with people that we believe in and that we feel are strategically aligned to who we want to be known as people in this business. And that stuff matters to us. And so call that corny. Some people probably don't care about that at all. But values matter to us. And so those were some of our criteria. There are more. We actually have this vetting criteria I put together based on my learnings in the tech world. And we actually run Madison Investing, our company, based on these. And so we look at things like track record with a nerdy list in a spreadsheet of sub-bullets and questions. We look at the team. We look at the legal side, at the structures of them in the legal side. We look at their operations and communications to investors. All those different things. And so I won't nerd out much harder than people really want me to on here. But I will say this: the number one thing with the operator that I really am interested in hearing, really beyond the track record, is have they been through some type of really challenging failure in the past? And it doesn't necessarily have to be within multifamily. because you have a lot of relatively newer players in the space, and how I want them just to walk me through how do they have their failure response kind of muscle memory conditions. And so I would literally want to know, like, what's the hardest hardship you ever had to face as an entrepreneur? And if they don't have a good answer to that necessarily on the multifamily or on the apartment syndication side or something like that, I'll accept other answers. When they come back and say they have no story and no major failure, I run away, because that's just either means you're either really inexperienced or you're not telling the truth. In either case, it's a non-starter for putting a 5-digit or 6-digit number of capital into there. You go.
Yeah, let's recap some of that, because you just gave us a lot of great nuggets. And I'll start backwards and kind of work from there. That number one question that you're looking for is, tell me about a failure. Tell me about a challenge, something you had to overcome. If it's not multifamily specific, something in business, something as an entrepreneur, because that's going to give you insight. And I'll go a little further too, because I love that question as well. And part of what I'm looking for, and I tell my investors the same thing. I say, this is a great question to ask. And it's not just the story and not just the fact that they overcame a challenge, but how do they talk about that challenge? Are they taking accountability for their role? Are they blaming other people? And sometimes things happen to you. I had someone steal money from you, right? So if they stole money, they stole it. But the accountability for me is, hey, we changed our vetting process. We changed when we write checks to the contractors. You want to understand, like, what can they do? What have they done? What did they learn from that experience? So those are some of the things that we like to ask as well, and just listen. I think the biggest mistake I ever made was I asked the guy these kind of questions, and he blamed everyone else. And I didn't pick up on that as a huge red flag, that this guy was not going to be accountable, that this was not going to be someone who was going to be present. And I missed that. So that's something I ask as well, just to make sure you get a good feel of the individual. And I love your point about values. You talked about the number one thing you look for in a sponsor or operator is kind of the values that they have. Do they have experience? Do they have the track record? You're certainly trying to check the box on those things. But at the end of the day, you got to ask yourself, is this a guy I can trust with my money or not? And that's really what it boils down to. Part of that's going to be in intellect. Part of that's going to be experience. But part of that's going to be on their values. Are they going to bust their tail and work hard to make sure they deliver on the deal and do the best job they can? Personally, I can live at night and sleep knowing someone did everything they could to protect my investment. It would really bother me if I knew someone cut corners or deliberately, mailed it in as far as, doing what they needed to do on the deal. So really great points there. The other thing, just to kind of go back a little bit further, you talked about for you getting into multifamily, that big aha moment was that first vacancy. Having that vacancy going from 100% occupancy to 0% occupancy. I think anyone who's doing, small properties, single family investments, that's something where when it hits you and you don't have any money coming in for that property and you still got to make the mortgage payment, you still have to pay the insurance, taxes, and other things. That's where you understand the predictability. And I know people get scared sometimes of investing in larger deals, but it's the economies of scale. It's the professionalism. And then it's also like buying a share of a larger company. When you have your single family rental, it's like 100% shares of a startup that, you're running and operating versus buying an established operation that has all the resources available to it, from property managers to lenders and all these other components, and you're buying a fraction of that company. So, from a mindset standpoint, you just have to understand that if you have $100,000 to invest, ask yourself, do you want to invest in a part-time job and basically be solely responsible for the success of that investment? Or do you want to find a good team, find a good operator, and find an opportunity to invest in where your vetting process is really all you have to do? And then from there is just monitoring the investment. So it's something that we certainly love. And, I think a lot of people understand or at least get it at a surface level, but it's good to talk to someone else who is both actively investing in deals as well as transitioning to the other side of it. You talk to a lot of investors. Obviously, you've been in that spot yourself. What are some of the main questions or the main reserves you get that you hear when you speak to passive investors?
Yeah, the tone of this conversation right there around the main concern has changed so dramatically since pre and post COVID. And And not to say we're done with it, obviously. We're in the middle of it, really. So when I say post-COVID, there's a lot of people going through hardship, and I want to acknowledge that right now. So I will just say it this way. Right before COVID, the primary concern that people had was, when is the recession going to come and what's that going to do? It's got to be it, And so what are they really asking with that question? What they're asking about are risks. And I'm going to just spell this out for people the way that I learned how to think about risk. Because when you go through the journey of working within a lender, and the lender is doing hundreds and hundreds of deals per month, individual transactions, every single one of those decisions, just like an investment decision, when an investor asks us, like, what are the risks if a recession comes? What's going to happen to my 50K, my 100K, my 200K, my 300K? That's a lot of money. What they're really asking me is, like, help me get comfortable with the risk profile of this decision. Like, if I put it in, is it acceptable? Is it worth the risk? In a lender, you have to make decisions around same stuff we just talked about, John. You have to think about the person's track record that's trying to take out a loan. You got to think about their business plan, same as the pro forma for a multifamily. I mean, there are different numbers and maybe some terms that are in there, but same concept. And then you have this other thing. And this other thing, I think you don't hear enough about it, and it's called compensating factors. And so, not to get too nerdy and technical for people, because I don't think that this is too advanced, but it's an important learning that I took away, and I want folks to learn from this too. People will ask us, why should I invest right now, for example, in the middle of COVID-19? And we don't necessarily know how long it's going to last. We don't necessarily know what market is going to recover faster. We don't necessarily know if, let's say, Raleigh, North Carolina, is that going to outperform Tampa, Florida? Like these are questions really no one on planet Earth, despite the confidence and egos that might exist in the real estate landscape, I would say no one for a fact knows what's going to occur over the next 6 to 12 to 18 to 24 months, because there's just too many variables. But that's what the reason we are still investing very selectively and cautiously and slowly is because of this thing called compensating factors. And a compensating factor could be anything, right? In lieu of other data, how much money is the sponsor themselves putting in? How many deals have they navigated through a downturn or through a rough patch, or just like the question we talked about earlier with failure response? Like, these are all compensating factors, money in the deal, additional team members, all these different things. And so when people ask me that question, that is absolutely the number one question that happened pre and now even post-COVID is, why should I feel good about this given the current context? And I think that question will always exist. If you talk to folks that have been in this business for 30 plus years, they will tell you point blank, the same questions people bring up now, the same concerns that people bring up now if they're trying to invest, it's almost verbatim. It just happens to be a different subject of the conversation. Maybe it wasn't, if someone did a syndication back in the 90s, they wouldn't have the point of reference for the Great Recession, right? So same topics, though, they would have pointed to a previous downturn. So sorry for the long-winded tangent on that topic. It's an interesting theme. And I want to help people pull back further to look at the market and think about this in bigger timescales, because there's always going to be an excuse to not take action. There's always going to be an excuse to not invest. Right now, this happens to mean you got to be more selective, and you shouldn't just jump into stuff, and you got to vet it even more. And you got to think about working with people that can actually help you identify that type of stuff, which is why I think we're growing so much, frankly, at Madison Investing, because people want the help before they actually go put the money in the deal.
Yeah, it sounds like there's two questions that, historically come up there. It's why this deal and why now? And those are where the compensating factors really need to focus on answering those things, because we can present all the data points we want, but unless you can address why this deal, why now, you're going to have a hard time, really getting investors comfortable with the risk profile of the deal. With that said, let's ask that directly. We're talking about COVID a little bit, and certainly there are investors who are sitting on the sidelines expecting, blood in the streets and prices to drop drastically. There are other investors who do not expect that to happen, who expect multifamily to continue to be resilient. And we're just talking multifamily, by the way. I think retail and commercial are a little bit different, but specifically for multifamily, why now? I mean, why should investors invest now? Why not wait until maybe 2021 when things seem to be a bit more clear? Why should they be investing right now?
Yeah, I think it depends on the person and the timing in their journey. And here's what I mean by that. So if someone is brand new to this stuff, but I would hope that before they get into any deal, you need to at least have some level of financial sophistication, right? Whatever sponsor that you might invest with, if I'm talking out there to a future LP or future limited partner, and you've never done one specifically in real estate before, you're going to have to climb a ramp a little bit on the education front. And I think it's better to do that before the absolute, bottom of the bottom of the bottom hits. And the reason being is you're going to want to be ready to go and pounce if you want to go into a more active track eventually. If you want to go and build a portfolio in a more targeted way, you're going to need to ramp up on that education. So I'm not saying go get into a deal that is not as good, but I am saying you want to start looking at the options that you have available in front of you, getting to know the people that you can actually go and transact with. And along the way, if you happen to encounter a sponsor that has a business plan that really pencils out and it has all the compensating factors that make sense, go for it. So that is one profile. Then you've got the experienced LP, right? And I mean, I'm trying to think of a couple of good names of people who are like the heaviest hitters that could be sitting on the sidelines, but I'll probably leave them unnamed for right now. I'll just say the people who have war chests and dry powder and whatever other buzzword in real estate that you want to use, the people who have a truckload of capital that are sitting there on the sidelines, they can afford to wait. They can also sit there and not have a single dollar of income come in their lives, and they'd probably be whole. There are people who are working full time, very successful accredited investors' careers, maybe even non-accredited investors, but they're making, VP sales, making $500,000 a year. I literally talked to one of these folks yesterday, and he's excited to go and invest in deals because he can still get cash flow that meets the levels acceptable to his own personal strategy and timeline. It doesn't have to be a 30% plus IRR to make sense for someone's strategy. That means they're taking usually a higher return means a higher risk. So bigger players, people that have huge war chests, people that have that much dry powder, they can wait that long to go and take those kinds of huge risks on smart buys. So I'm sure, I'm going to get messages back from people saying, I don't agree. That's fine. Everyone's going to have their own opinions on this topic. We have slowed down our own investing strategy. So we did do a lot more transactions last year. We did invest capital in a lot of transactions last year. We've done one this year, and that one, it was through COVID, by the way, and like we were working on the GP side as well through COVID, which was its own story. And we ended up looking at this one deal, and the risk resilient and the resilience picture on this one deal, the occupancy break even was so excellent. It was the best I'd ever seen of any multifamily deal we've been a part of, meaning the building could literally be half full and the thing would still be positive, would operationally profitable. So, I went on a few twists and turns there, but to give you a detailed kind of no BS answer, John, I just think that it's not a binary thing, man. And it's as easy and as nicely tied with a bow as people try to make this stuff. It's never black and white. It's never black and white. And the world's not black and white, nor is decision-making in a business context, whether it's in the corporate W-2 world or whether it's in real estate. And if you're binary about it, you're probably going to miss out on some stuff.
No, and I think to your point, it's one of those things where it's going to come down to the individual. You have to understand your own circumstances. If you are sitting on millions and this is really just about being richer or maybe getting your jet, then by all means, sit on your dry powder and invest whenever it makes sense. But if taking a year or 2 years off from investing hurts you and hurts the trajectory and the goals that you have for you and your family, hurts your ability to spend a little bit extra time now with them, and you're willing to take maybe a little bit less returns for a little bit more certainty or diversification of your portfolio, you should strongly be considering investing. And again, obviously I'm a little bit biased, but I do think that people should be looking to take action now, because there's going to be a lot of money made if the market does fluctuate. And if you are concerned with the stock market or your home values or things like that, it may be a good time to take some chips off the table from that diversify it into something that is more cash flow focused, and go from there. But again, to each his own, figure out what your plan is. But I would say that you should still at least be exploring the opportunity of investing in multifamily, even if you don't pull the trigger. Spencer, I want to go back real quick in the little bit of time we have left. You are in 6,000 units, I believe. I might be getting that wrong. 5,000 units. I think it's 600 million. I'm sure most of them are going great. I can't imagine every single deal and every single operator has been flawless and perfect. Without giving names or deal specifics, what are some of the challenges or some of the deficiencies that you've seen across some of those deals where you say, hey, you know what, here are a couple of things that I wish these operators could do better, or a couple of things that as we look for opportunities, we would change maybe our criteria going forward?
Yeah, and I'm happy to be as real as it can be on this topic. I think it's an important learning for people while they're thinking about crafting their own strategy and trying to pick the right sponsors to work with and make the right investments for themselves. So the number one thing that matters most beyond the performance of an investment, in my humble opinion, is the communication from the sponsor. And when we are investing in a deal, before we got active as well, we would see examples, right? I loved that experience. I love that experience of early learning as LPs or passive investors in multifamily syndications, John. When I would go in, we'd invest, and I'd see those monthly emails. Usually they're coming out monthly from some of them, the newer sponsors. Sometimes they're quarterly, which is fine. But when I'd see it done well, man, it's fun. Like you get to see how the thing is tracking, how occupancy rates are going up. Hopefully they're going up. Hopefully they're stable. Sometimes they're going down. So I would say that one of the things that didn't go well in one of our earliest investments was you actually had a property that sustained, what basically major weather caused damage early in the hold period. So we had just invested something like, 5-6 months prior, major damage done to this building. And that hurt, and frankly, we haven't gotten distributions from this deal for, a year and a half or something. And I am so excited about how the deal is going to pan out, though. They had to go and course correct. But I will say this, you're taking a risk. And that earliest deal, like I said earlier, that was the same one I used in that story. And so I would just say that deal is going to go so well. I feel really good. I'm going to invest with that team again. I think that you just got to understand where stuff fits within your plan, because acts of God are not something you can put into a business plan. You do need cash reserves. And you do need to make sure that when something like that happens, the sponsor has a choice. Let's say that, there's a lot of folks going out there right now and on the sponsor side trying to navigate the challenge of a thin layer of cash reserves. If they didn't plan well enough, if they didn't have they didn't have enough buffer to have a big dip in occupancy from the multifamily properties. And so they're going to be faced with that challenge if they haven't already done it yet, which is, do they have to go back to their LPs, to their passive investors, and ask for more money? One of the top questions you get from investors, as you know, John, is like, well, have you guys ever had a capital call? And so we get that all the time now that we're on the active side of this business is, have you had to go back to your investors and ask for more money? So that hasn't happened to us on that deal that I brought up to you earlier. And it's because the GP team put more of their own in. And so I don't think that that's necessarily a requirement for a successful deal in the event that the worst happens. But I think that is an example of something that is it's real, and it has happened on the passive investing side to us, where we're not getting distributions from a particular deal. And so I think that is one example that I think is super relevant. And on the communication front, though, it's they crushed it. They were so good and so forthright with being upfront with us when that happened.
And Spencer, that's what I was going to follow up on, because I think that's the key for me, at least. So you talked about communication, but even though there was this act of God and you haven't received distributions in a year and a half, the communication was clear. They were upfront. They were honest. They kept you informed of what was going on. That even though it wasn't good news, you were at least felt confident knowing the guys are doing everything they can. The guys and gals are doing everything they can to drive that deal, still have a good plan, pivot as necessary to execute. And that's really the best you can do, right? And I think as you,
that's right.
as LPs, as you look for operators, that's where the value, that's where all that comes into play. You want people who are going to continue to find ways to make the deal work, to be proactive, to be creative, to tap into the resources that are available to them. If necessary, tap into their pockets, which I've had to do. And those are the kind of things that you want to have that available to you, right? And that's going to make sure that you're aligning with the right team and you are in a position to be successful. So thank you for sharing that. Let's transition to our bullseye round. You ready?
Oh boy. Yeah.
All right, Spencer, give me a failure or an apparent failure that set you up for later success.
Yeah. So this is actually not from the real estate world. This is from a startup I used to work at. I was part of a hot, quote unquote, startup, like a unicorn startup. That means they're worth more than $1 billion, right? We were growing like crazy. And I had to be the guy who hired a couple key teams: customer success team, sales team, operations team. We were like quadrupling the size of this team in like an 8-month period. I overhired like crazy. I didn't mean to. We were hiring ahead. That just means you're hiring before the business needs it, but we did it. The business stalled out. It still grew, rather, but it didn't hit the trajectory that I thought was going to happen on the forecast. And so where was I 8 months later? I was literally sitting in a room, having to let people go. And sitting across the table from a person that you're letting go, and you're the person that hired them. You're the person that sold them on that team. You're the person that sold them on the vision, and watching them break down into tears is not exactly the best memory that I have, right? And imagine multiplying that by 12 different people. And so that has got to be a heck of a good learning failure, because what I learned from that is the way that we conduct ourselves in business when times are good is not representative of what it means to do things right. The way we conduct ourselves when business gets hard, when you have to make the hardest decisions, that's when the metal and the true qualities of leadership come to bear. And so that's got to be mine.
No, great story there. I appreciate you sharing that. Give me the book you've recommended or gifted the most in the last year.
Oh man, this is like eerily convenient. Here you go. So it's still got to be the most #1 recommended book on every podcast I've ever heard. But Rich Dad Poor Dad. If you're on the podcast version, I'm holding up the actual book to John here on the video. So yeah, it's got to be Rich Dad Poor Dad. It's just so fundamental. I'm going back to reread it right now to take some notes before I put together some more of my own content. But that book, man, the pipelines and the buckets. It got me so hard with the pipelines and the buckets.
Give me a digital or mobile resource you recommend for your business.
Yeah, so I think that if you're in real estate, specifically in multifamily real estate, I have to give credit, for the SDA, for Michael Plunk's SDA. I think that it's just too good, like I basically paid $129 for that thing a few years ago. I went through Michael's underwriting program. When we get LPs or passive investors in our own business and they're getting the inkling like they want to go active, I usually recommend that one, frankly, because I still use it to this day. They get a lot of value out of it, and I'm just a big supporter of it.
Give me a daily habit that helps you stay focused on your goals.
I calendar block like a madman. And that is something that really evades people because it sounds so simple that they don't give it credit. Calendar blocking, all that means in this context is I'm opening my Google Calendar, maybe you use Outlook, I'm blocking 100% of the working hours. So for me, that's going to be something like 7 to 5. All of it is blocked. And that doesn't mean just with meetings with other people. That means what I literally put down GSD as the name of a block, John. So
I know what it stands for, but go ahead and tell the rest of the world.
It stands for, let's just say it's getting stuff done. We'll use the appropriate version of that. But the GSD blocks are my lifeblood for getting work done.
Love it. What's one thing you know now that you wish you knew when you were starting out?
I wish that I understood goal setting on cash flow. And what I mean around that is using the story from earlier around the duplex purchase when we bought a duplex in the Bay Area. It's gone up. But when people often buy and they make investments, what they don't understand is we're all taught by Wall Street to make a portfolio, and that big pie chart that I'm using a hand gesture to represent in a silly way, that's how we're supposed to think about investing. And that's not the only way. Frankly, I think it's a confusing way to do it. our way of goal setting now has been and will be, what is our monthly household cash flow? How positive are we? That's a much more straightforward, what I have found is a much more successful way for other people to wrap their minds around goal setting, to make it real. Like, is this decision to go buy a new laptop going to raise or lower our monthly cash flow? Is that the decision to go invest in that multifamily syndication going to raise or lower our monthly cash flow as a household? And so that has got to be the earliest goal setting change that I would have made.
What are you curious about right now?
What I am curious about the most right now is education within the real estate sphere. And what I mean by that is there's a massive opportunity to apply modern tools, learnings, philosophies, approaches that you usually see in world like the tech world to real estate. And it's not happening nearly as fast as it probably should. Meaning, my last gig that I had at Lending Home, the earlier hat I wore was building an operations and sales group, a loan origination group. The latter hat that I wore was around being a leader of professional development, learning and development. Man, there's so many wonderful coaching programs out there, but I will say the democratization, if you want to use that nerdy term, around how people get into this stuff, taking out the mystery, making sure it's more readily available for other people. I'm an abundance mindset guy, and all people might hear that and who are old school in real estate and think, ooh, don't share my secrets. That'll mean that we actually lose more business. I'm sorry, but that's some old school shit, and it's not going to last long, and it's not the way to conduct oneself in business. And so I'll take that one to the grave. So like, that is the opportunity within real estate in education. I'm curious about that.
Yeah, there's a lot of opportunity there. I mean, we see it as well, and we try to give as much great free content as we can, and anything coaching related is really more about the time and the network and the intricate details. But I tell anyone, hey, before you spend $1 on coaching, check out these podcasts, check out these books and specific ones, and figure out what you need help with after checking out that content, because there's a lot of great information out there. And to your point, I mean, if there's a way to democratize it or make it easier for people to get in, learn what they need to learn without dropping crazy amounts of money, I think there's ways to do that and help people out. You know, we talked about a lot of great things. We've talked about you being in the Bay Area, and the Bay Area has some great cuisine. Give me the best place to grab a bite.
Oh my God. No. You know, I really am. I'm kind of hot on this one place right now and I want to support it. It's a local business here in Alameda, and it's actually just called the Town Tavern here in Alameda. So I got to give a shout out to them. I got a burger delivered to my house the other day. That was just the most amazing thing I'd ever eaten. In all fairness, I probably hadn't had a burger in like 3 or 4 months because of the quarantine. So it was outstanding though, man. So the tavern within Alameda has got to be it.
Awesome. We'll definitely make sure you check that out the next time we're out there in the Bay. Spencer, how can our listeners get in touch with you?
Yeah, 2 ways. So we have our own website, MadisonInvesting.com. That is the place where you can actually go and just sign up to join our passive investing program, where we're basically putting our own money into a select few deals. After we vet them, we share with you how we vet them. And then, we also are on the active side of those deals too. So MadisonInvesting.com. And then LinkedIn. I'm actually like super active on LinkedIn every single day. So feel free to drop me a line or connect. No need to necessarily, to connect if you're not comfortable with that, but I promise I won't bite. I'm happy to share learnings.
Spencer, this has been a lot of fun and very educational. I really appreciate you sharing your journey from kind of coming up as a real estate guy, kind of in the family, but focusing more on the tech space, and then kind of circling back to real estate investing, both as a passive investor, turnkey, then in the syndications, and now ultimately on the general partnership side. You gave a lot of great information on how to vet syndicators, how to vet operators, how to look at deals, talking about markets, and really just a lot of real rich information that I think our listeners can use as they explore their own personal finances, understanding their goals and what they need to do to create cash flow for their family. Thank you again, man. I'm sure we'll be in touch, but it's been a pleasure talking to you. Thank you for joining us on Target Market Insights.
Thank you so much, John. It's been an honor to be here, man. I really appreciate it, and I really enjoyed the discussion.